So I look at this and say to myself, yeah, no one likes inflation. But if you look at what Trump is trying to accomplish, sure seems to me having a Fed that went and lowered rates artificially too low would be in his kind of best interest for what he wants to.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with not another edition of the Daily Dots. We're back on the interview circuit, and I can't think of a better guy to start us off. Kevin Muir is with us today, and he's got a great podcast of his own, The Market Huddle. And I was thinking back, Kevin, I think you were probably one of my first 2 or 3 interviews 9 years ago when we started doing this.
Really? Is it that long ago?
Yeah, you were one of the first guys because I remember running into the MacroTourist blog via Zero Hedge.
Oh,
and I refer to those as the dark ages in my intellectual journey.
Yeah, but now Zero Hedge, though, by the way, he's a intrepid White House reporter.
Yeah, and it's.
If there was ever a signal of the time to flip your market view, getting all bullish, that may have been it.
Yeah, no kidding. And then I'm also joined by the brain trust himself, Mr. Chase Taylor. He's kind enough to join us. Chase has co-hosted the Market Huddle before and been on it many times.
Yeah, Chase is my fill-in whenever I can't do it. Patrick's always like, "Oh, I'll get Chase." Yeah,
there you go.
One day I think I'm going to get replaced by Chase.
I don't know about that.
Well, Chase is like an honorary. He's like an honorary Canadian.
Yeah.
Well, you kind of are.
You both are.
I could identify as a Canadian.
Yeah.
Hey, Vancouver's one of my favorite places. So
Vancouver. You talk about a food city. The food in Vancouver. The restaurants
Zach,
there.
Listen, I understand Vancouver is beautiful. It's absolutely one of the most stunning cities out there in terms of its beauty. But if you actually on food, I'm going to take a little bit of I'm going to stick up for Toronto here. Toronto is the most diverse country or city in the world. It really is, like, in terms of it's been objectively proven. I have buddies that come from here and they're like, holy smokes, I had no idea you could get XYZ country food here. It's everything. Like, the CNN guy came and he was just like blown away by the food. So if you want diversity, come to Toronto and we got everything.
You know a city that I really liked too, and it was so old and it was so charming, and I actually had some incredible food there too, was Montreal.
Oh, Montreal's beautiful. Yeah.
It really is. And you got some of those, it's a modern city, but it's so old, right? It's
feels like
old.
in Europe.
Yeah, it's so much older than any US city. And so they had some of these streets, Kevin, that you go back, they're still cobblestone and they're barely wide enough to fit a single car.
Yeah,
you know what I mean?
Montreal is called. Zach, if you like that, you should go to Quebec City. It's got even more charm. It's like old Montreal, but the entire city almost.
I love it. I'm a big fan of Canada. So speaking of which, and before we get into before we get into some of the more investing, the nuanced investing stuff that we're going to talk about, one of the things I want to talk to you, man, is a lot's been going on with Canada. What is the take there? How much of this? I mean, Chase and I were just having a discussion about Trump and how much of it's serious, how much of it's blowhard. Yeah. Like what is the? I mean, I think we all know that we don't really get a good view of things listening to the news and the media's interpretation of things. Well, like, what is the feeling and the words on the ground there? What is the average Canadian person thinking these days?
So when it first happened, I think hurt, angry, upset. Like, this is like, going to bed with your partner for many years, decades, going through thick and thin. and then waking up one night and getting punched in the face. That's literally what it was like. Like, it was just like, holy smokes, like, where did this come from? I think we've adapted, we've accepted, and we're changing our economy to reflect this new reality. And one of the things that I don't think that enough Americans understand is that the damage done in terms of these relationships by Trump is such that it will be many years, maybe generations to fix. And, you know, we could talk about whether he was right and whether we didn't pay enough for the our military, whether we did X, Y, Z. Well, the reality is that adults can have that conversation without you threatening to take us over. Now, like I ask people, I say, imagine if during the Biden administration, Trudeau had said, I am going to rip up the USMCA. I'm going to charge 30% or 25% tariffs, and I'm going to take over Greenland. Like, imagine Trudeau had done that. I think that America would have rightfully been going to the UN and saying that Trudeau needs to be replaced, that you can't have a nation attacking another sovereign nation. Like, it's just not, it's unheard of. So I don't, like, a lot of people would be like, oh, it's just him joking. It's just, you know, Trump being Trump, blah, blah, blah. The reality is that because we are so dependent on our relationship with you, you know, we're your biggest trading partner, but as a percentage of your economy, it's tiny. And you're our biggest trading partner, but as a percent of our economy, it's huge. So we are at a disadvantage because we're so reliant on you. And there is no doubt in my mind that if you guys wanted to crush us in terms of whether economically, whether militarily, we are done. There's no doubt about it. Like, it's not even pretending that we could fight back on either of those fronts. But now we are sitting there going, okay, we've relied on America, this relationship being good for a long time. It obviously isn't. We can't rely on that. We don't know if he's going to wake up tomorrow and do something crazy again. And we're restructuring our economy. We're restructuring it, and I think to the better. We're restructuring it so that we no longer are beholden to selling you oil at $10, $20 discount or percent discounts, right? And like, that's the thing about it. You guys actually had it so great with us. Like, we were idiots. Like, we were complete and utter idiots. We sold you our oil at $10 to $20 persistent discounts because we were landlocked and we didn't go and get our oils to the coast to be able to sell it on the world market. We would go, and we are dependent on you guys in terms of selling all of our natural resources. We do very little value add. We are a big, huge CRB, index for you guys. Right. And the reality is that when you take out the commodities and look at the value added stuff, like the things that actually make jobs, like buying things, we are actually at a credit with you guys, meaning we buy more stuff from you guys than the other way around. And even cars, like everyone talks about cars. Well, go look at the cars and look at how much we buy versus what we sell. It's pretty well even. That was the whole idea of the auto pack. Now, Mexico, you have a much different situation with. They didn't buy nearly as many cars from you. So although Trump is right saying that they buy, U.S. buys X billion dollars of cars, we also buy X billion dollars of cars from you guys on a whole, equally. So netted out, it was pretty well even. So this is a long-winded way of saying that I think that you actually had a great relationship with us. It wasn't perfect. There's no doubt that we could have been better on the military front, but on the whole, this was a huge plus for you guys. And now all of a sudden, we have no choice as Canadians but to go out and rearrange our economy so that we can sell our oil on the world market, so that we can go and have other trading partners. So, it is what it is. And my point, though, that I think a lot of people miss is that there is no going back. And I think that's the thing that people say, oh, it's okay. We're going to have we're going to go and do a deal. Well, listen, how can we do a deal with a man that actually reneged on the deal that he did?
Mm-hmm.
Right. And like, I think that's the part that unfortunately too many folks don't understand or don't appreciate. And they go and they say, listen, the world's been taking advantage of the US for years and years and years. So I might push back a little bit on that and say the US is the most prosperous, economically rich country in the world. And that you guys have absolutely done terrifically in terms of how you've done. You might have a problem with your distribution, meaning that like how you guys distribute your wealth, but as a whole, you guys have, being the most prosperous country in the world. And now he's saying that you guys are getting ripped off. So instead of being 70% of the world's wealth, you think you should be 80 or 90. I don't know what he's trying to accomplish from that perspective. But I think that the one thing I do believe is that the rest of the world, no matter what, is going to be rearranging itself because we have no choice. Like you can't, a deal is a deal for as long as Trump wants it to be a deal. And then the reality is that he might tomorrow rip it up again. So that's not a kind of a long-term relationship that's in anyone's that you can count on.
Yeah. Yeah.
I'm sorry for the rant.
No. And I, you're such I've always known you to be such a level-headed and fair thinker about this, especially from your perspective. I want to hear, because as an American, when I think about the countries that have taken advantage of us, Canada did not pop into mind, right? The other thing I'll say is that while I do think that there are quote unquote countries taking advantage of us, like China, I don't really fault China. No. I fault us, right? Yeah. Like meaning if you leave your back door open, don't be surprised if a bunch of raccoons come in the kitchen. You know what I mean? Like, you know what I mean? And so that's kind of been a head scratcher to me. And this is a question that you should probably be asking me. But I'm going to ask you because it's still a bit quizzical to me. Do you know what, from your guys' perspective, do you know what, when this whole Canada thing came up, it would just hit me right out of the blue. I was sitting there going, boy, I didn't have them at the top of the list of issues we had to deal with. What did you guys attribute it to do? And maybe it's Trump just being Trump, but like I said, I think Trump says a lot of crazy stuff, but I feel like usually the crazy stuff is a means to an end. Like maybe he thinks it's getting him closer to a negotiating point. This one was very quizzical to me. From the very get-go, I was sitting there going, I don't know what you've got to gain here.
Yeah, I don't either. I'm probably just going to get myself in hot water by talking about it too much. Like, I don't know if it even matters, Zach. Like the reality is that trying to get into his brain and figure it out doesn't matter. We as people that are in charge of money, we have to take the reality on the ground and we need to adapt. And I'm happy about the decision our country is going, and I'm happy that we are going to change it. And in some ways, you know what? He might have done us a favor. We might get off our butts and, stop, not emphasizing business. We might end up doing things. And listen, to your point about what has changed in Canada, I can tell you that there has been a dramatic change in people's attitudes about resource development. I think I saw in the paper today, Quebec, who has long been standing in the way of a pipeline across the country, is all of a sudden much more on board with it. I laugh and I say I have a bunch of young kind of early adult kids, and whereas before they used to say no, we can't have pipelines, it's bad for the environment, all of a sudden they're like much more amenable to it. And I laugh. We have a Green Party here in Canada. I said seems like the Green Party's willing to go work and lay some pipe and actually do it, because that's how much we feel we're threatened by this. And if there's one thing I would say is that it might not have seemed like that big a deal to Americans, but trust me when I say it was a huge deal to Canadians. And we were very, very, very hurt out of the blue. And it's disappointing, and I'm hopeful we can fix it and that we'll eventually do it. But ultimately, in the meantime, we have no choice but to make our economy less reliant on the American economy.
No, I mean, and it's not something I like to see, but I do think it's one of those situations where the threat, if you're in charge of that economy, the threat is just as pernicious as the reality. Like, meaning, you don't need that to actually take place to prompt a change.
Exactly.
The fact that risk is on the table means you have to have the change.
100%. And that's my point, is that just the mentioning of it, even if it's a 1% chance that he actually wants to do this, you still need to go and adapt for it and change your economy based upon that.
Yeah.
So speaking of cold water or hot water, I want to talk about cold water. Okay. Something that one of the reasons I thought this was a bit of a strategic blind spot. If you look out 20, 30 years from now, if the ice in the Arctic keeps melting, anywhere near trend, then all of a sudden global shipping is very important in the Arctic. It's way shorter distances, way faster. And that becomes incredibly important for the Northwest Passage and for Canada, and by extension for the United States. You guys are developing deep water ports in the Arctic, naval refueling stations, new military bases in the Arctic. And this naturally sort of combines like Eurasia, because the shipping times between Europe and Asia get dramatically cut, and obviously so does the cost. So the natural like integration almost is like forced on the ease of shipping. And then you tie in Canada through the Northwest Passage. The ability for you guys to integrate more with essentially the rest of the entire world are about to like really open up. So like the economic opportunity 20, 30 years from now is dramatic. The opportunities to decouple more from the US, obviously not fully, that wouldn't make any sense for anybody. I just feel like the timing of this for you guys to look outward also happens to like combine with new opportunities that are physically happening. But I'll pivot real quick to like deficits. You've been awesome at identifying fiscal as a powerful driver. And I think you're starting to see that. You guys are clearly going to expand your fiscal deficit. People listening, you can go look at EWC, the Canada ETF in the US. It's crushing the US. It's doing great this year. So I talk a little bit about fiscal in Canada and the way you view fiscal as an important driver for economies and obviously for equity markets.
Okay. Just quickly about the Northwest Passage and things like that. I completely agree. It will become a hugely important issue. One of the things that scares me is that I worry about Russia going up there. And in the past, like Russia goes up there and America wouldn't put up for that, wouldn't put up with that for 2 seconds, right? Like the reality. Now all of a sudden when Putin goes and starts, going in on our turf, are you guys really gonna come to our aid? Like, so we do need to, up our game and really be aware that the next and most important area is the Arctic, and it's not going to do wonders for our image, Chase, of being all cold and stuff, but it's going to be really important that we get up there. Okay, pivoting to deficits and fiscal. Completely agree. Think that in the last 5 years, really the people that have done the best in terms of macro calls are those that have, abandoned the old idea of focusing on monetary and really understood and embraced the idea that fiscal drives way more than people expect. One of my reasons that I got bearish on the US stock market in late 2024, early 2025 was I looked at this 7% deficit and I said, looks like they're going to try to get it down to 3. That was Scott Bessent's line. And that was a reason to be bearish on the US stock market. I remember, Chase, you calling me up and saying to me, like, Kev, he says he wants 3, but he doesn't really want 3. I don't see it. And I said, yeah, I get it. But the reality is I think he's going to do tariffs higher than everyone expects. And I still do believe that that's the case, that tariffs will be higher than most people expect. But it was this kind of difficult balancing act. And one of the reasons I think that we've rallied so hard in the last month is that we had this situation where Navarro was kind of making a mess and Trump was making a mess. Scott said, listen, I'm going to take over here and I'm going to get everyone in line. He took over. It was kind of like the adult was all of a sudden back in charge. And one of the reasons of the past week or two that seems kind of most frightening to me is that you guys are running 7% deficits to GDP. And it looks like you're going to up them. Like it doesn't, there is no sign of any sort of fiscal kind of consolidation and the idea that you have to continue, spend less. So I think that as the market has understood that, that's been part of why the U.S. stock market has just rallied so hard. So up until, a month ago, I think it was a really easy play to say U.S. is 7% on its way to 3%. Canada is 2 on its way to 5 because of this existential threat. Therefore, Canada is going to do better than the U.S. And it's kind of an easy trade from that perspective. And I don't think it's just Canada. It's the whole entire world. Like, look at how important fiscal deficits are when you see Germany. Germany went and had this self-imposed constraint. The moment they lifted it and said, we're going to spend, the stock market went straight up. Like it was like just amazing. And so for anyone who doesn't think that fiscal drives stock market returns, I just beg them to go look at that response. And this is unfortunately in this strange spot we're in now, because it seems to be like everyone's doing fiscal, right? Because Trump has made it so the rest of the world needs to do fiscal. And that was very welcome because let's face it, Europe wasn't spending enough. Even Canada, we were running a fiscal of 2. You were running 7, we were running 2. Ours should have been higher as well. The trouble is now we're at this weird spot where the rest of the world's doing a lot more, but the trouble is so is the US. And this is why I think that we're at a spot where bonds could break. And I was
about to say, if everyone's doing fiscal, who buys all those bonds?
Right. And that's, to me, that's all of a sudden I've been like, you'll remember, Chase, I've been a huge bond bear for the longest time. I was thinking that if they pulled back on fiscal and the U.S. economy rolled over, I wasn't bullish bonds, but I wasn't as bearish. But given this new stance, I'm really thinking that the chance of a Liz Truss moment is increasing. And I think the bond market is a really in a precarious spot that very much could surprise everyone.
Let me ask you something, Kev, real quick.
Yep.
If you're playing that bond move, and I couldn't agree with you more, where do you think the best way to play it? Do you short bonds? Do you play for higher rates, or is the trade gold?
Yeah. So listen, gold has been outstanding, and you're absolutely right. They almost seem inversely correlated right now, meaning that bonds go down, gold goes up, and it's occurring all the time. And I do think it's a slightly different trade, though. So I wouldn't just go buy gold because I think bonds are going to go down, and I wouldn't do that. For me personally, I'm of the belief that we get an extremely steep yield curve, meaning that the front end stays low. And in fact, I could make the case that I think there's a better chance than the market realizes that Trump is still going to fire Powell, and that they're going to lower rates. And much to everyone's surprise, instead of that causing the long end to go up in price, it's actually going to go down in price, meaning it'll go up in yield. Mm-hmm. So it wouldn't surprise me if we got into a situation where Fed funds is 2 and the 10-year is 6 or 7. And I know that's crazy, but listen, this is crazy times and some really wacky things could happen. And if we get into a situation where the 10-year is 6 or 7, then all of a sudden it doesn't, your investing in bonds is going to really hurt for the next year or two as we get to that point.
Well, and every dollar, every dollar I think about flowing into gold, that's a dollar less to flow into treasuries. And it's something that we've been talking about for quite a while. And Chase brought that up too, was that idea of, perversely cutting rates might be the very thing, especially I think if you cut rates due to economic weakness and unemployment numbers going up and things like that, then I would expect the long end to fall. But if you start cutting rates right now as a stimulative matter, when you've got 7% deficits, like you said, I think there's a really good chance you lose the long end.
We actually saw that. Trump, Powell cut rates and the long end went down in price, up in yield. So I don't even, and that was the economy kind of rolling over a little bit, but I think it was the economy, the market saying, hey, wait, you're probably getting ahead of yourself and you are doing it. And like people are always confused by that. And I always say, well, listen, if you think about a long bond investor's worst nightmare, it's inflation. And if you have a central bank that is encouraging more inflation, that means that it's going to hurt your long bond investment. So when you ask me what you play, I've gone and I've bought kind of 1 year puts on the 30-year bond. I think that's the way to do it. Like there's a chance of a real problem. And listen, we can talk, I don't know how technical your audience is, but there's this other kind of phenomenon where there's this situation where investment managers are using futures in the long bond as their duration bet. Meaning, like, if you're sitting there and you're a pension fund and you want to own long dated bonds, a lot of times what you do is you use futures because then you have the extra cash, because you only put up a certain portion of the future. You have the extra cash to go do private credit or to go, buy some short dated paper, and you can play around at the margin. So it's a way to get some leverage and like to get your duration by using these futures. Now, the trouble is there's something called the cheapest to deliver, and that's the bond that is deliverable into that futures contract. The seller actually has the option of which bond they deliver. And I had this really smart subscriber of mine email or DM me on the Bloomberg, and he says, pull up this, the long bond CMS screen, which shows you the cheapest to deliver under various scenarios. And if you looked at it, and if rates went down 50 basis points, the cheapest to deliver bond stayed the same. If it went down 100 basis points, it stayed the same. But if it went up 50 basis points, it changed. And what was interesting was it changed to a bond that was longer in duration and had a lower coupon. Sorry, it was longer in tenor and had a lower coupon, both of which make a longer duration. So ironically, there's this weird thing in the market right now, whereas if the rates go up at the long end, there's going to be a situation where those futures become longer. And it's not just slightly longer. It's like goes from like 10 to 15 years of total duration. It's like big. So it's actually really shocking. Now, some bond fellows will push back and say, no, the market understands that. These guys are bond managers. They completely get it. Which point I call BS, because it's one of these things that sure, they might say they understand it, but the reality is nobody actually thinks rates are going up 50 or 100 basis points at the long end. I think that they've completely underestimated that, and that they're going to be shocked. So they're going to be what's called negatively convex. They're going to be getting longer as it goes down in price, up in yield. And so that could cause more selling.
It's a bit of a self-reinforcing loop that would be, and if you think about the backdrop of liquidity in the treasury market, just in general, which is not great, to have a bit of an illiquid market and to have that reinforcing loop that could create a bit of a spiral, that could be some significant action. I really loved that piece. That was super interesting. One quick question I have for you is, this is something it's been a struggle for me to try to wrap my head around. Like, obviously there are a lot of drivers to push yields higher, to include just the gravity of other yields, like in Japan's long end, right?
Yeah.
But we're hearing about the SLR tweaks, things like that. The taking treasuries out of the leverage ratio. Like, do you think some of these tweaks that Bessent is likely to utilize in the next few months can stand in the way of this potential move, or do you think just that all gets blown out?
So for those who don't know, the SLR is basically the amount of if I understand it correctly, it's the amount of capital that banks are required if they are long treasuries. And I agree, first of all, that the SLR should be removed. And ultimately, it is what's going to be needed. In my day when I worked at the bank, I can tell you I was an equity derivatives futures trader, and we were constantly long stocks against short futures, and we had to fund that position. And we would always fund it in the overnight. And we had the ability to go out and lock it in. But the reality was the curve was always so steep, it made no sense to do it. It was just better to just let it float. So we were in essence creating credit because we as a bank were borrowing from, the central bank or other counterparties to go do this. So ultimately the SLR, and when I go, by the way, Chase, when I go talk to the bond guys, I would be like shocked. They would always be long everything. Like they would just be long every single bond under the sun. And the reality was, in a steep yield curve, it makes sense for them to be long, right? Like they're sitting there, they're funding at 4 and they're own a bond at 6. Then every single day it goes by, they just chip. And there's the pull to par and stuff like that. So I'm very sympathetic to the idea that ultimately the SLR should be eliminated in terms of that, or relaxed, and that this is going to be how the U.S. government funds itself. It'll be with the help of the banks. But the problem is right now, the curve isn't steep enough for that to occur. So here, let's just pull it up. What is the overnight versus with the bond? Let me just pull it up and we'll see, because it'll just show you like how little there is. So overnight Fed funds are 4.30. Okay. And so what is the 10-year? The 10-year is, what are we, 25? So 35, 10 years, 4.47. So you're picking up 20 basis points.
Yeah.
Nobody's
so you need rate cuts to push them into it.
Right. So the SLR is needed and it will help, but it's not going to help with a flat yield curve. It's still going to take a yield curve that is steep enough to encourage that sort of behavior to go on. And that's ultimately what's going to happen. And like, if I could, I'll give you my theory about Trump and Powell. If you think about what Trump is trying to accomplish, he wants to lower the deficit, the fiscal deficit, and he wants to lower the trade deficit. Okay. Well, one of the big impediments to lowering the fiscal deficit is the fact that the rates are higher and the cost of the government more to borrow. So if they went, and let's just imagine that they forced the Fed to lower rate the front end to 2, and they just let it all float at the front, they could have their cost, right? All of a sudden that funding is half. Okay. Then in terms of what's going to happen in terms of the dollar, if you have a situation where you go and you artificially lower rates, you'll have the dollar selling off, which again will help in terms of lowering your trade deficit. So I look at this and say to myself, yeah, no one likes inflation, but if you look at what Trump is trying to accomplish, sure seems to me having a Fed that went and lowered rates artificially too low would be in his kind of best interest for what he wants to do. So everyone says, oh, well, he's never going to do that. The market is going to freak out and it's going to cause all sorts of problems. Well, let's not forget that he just went and did these crazy tariffs. He told everyone that they're being panicans. Okay, remember his panicans. And so he's told everyone they're going to be panicans. And the reality is that what's happened now is that he's proved correct. So when I look at that, I say to myself, is that encouraged or discouraged him from doing kind of crazy behavior? It looks to me like it's only encouraged it. So I think about this Powell thing and I think, you know what? He might do this. And people say, well, you can't fire him because the reality is that Powell will take him to court. I have no doubt Powell's going to take him to court. But like when you fire someone, you go home and you spend 6 months in court fighting about stuff. In the meantime, Trump's going to do what he wants to do. So I guess I think people are being overly complacent about the chance that he gets fired. I'm not saying it's going to happen for sure, but I'm just saying if you took the average Wall Street person and ask them what they expect the chances of that occurring are, I think a lot of them would say almost zero. And I would say it's not almost zero. It's probably 1 in 10, 1 in 20, maybe even higher. Sorry, 1 in 10 or 1 in 5, maybe even higher. Like it's like that's the kind of number I'm thinking. Still low, but not zero.
Well, it goes back to the same idea, about the market knows better and bond managers won't make that mistake. I mean, look, we all sat there and watched. I think we all just rolled our eyes in disbelief when we found out regional banks were sitting on piles of duration with inflation cranking through the roof.
Was that, hey, Zach?
And then to your point, though, to think that the market knows better now, I've seen zero indications that's the case, right? The other thing I've seen zero indications of is that people, as crazy as it sounds, people are still asleep on the issue with bonds, and I don't know why that is. It doesn't make any sense to me, but and I think it's just 15 years of ZERP and government intervention, but just the risk identifying nodes, if you will, of this market. It's like they've just been completely retarded and muted out.
Oh, you're allowed to say that now, Zach.
Yeah, well, because I'm not a panicking.
Yeah, didn't you come to our show? Didn't you use that word on our show?
I vividly remember that.
Did I ever use that word?
But you didn't use it in this context because that was good context this time.
Yeah, I used it? I used it in the wrong context.
I think you did.
Yeah,
I was like,
I was walking in the aisles of Target listening to it. I still remember where I was.
Yeah. Well, gentlemen, I've been known to be able to fit a foot or two in my mouth at the same time. So.
Can I give you my theory of why everyone thinks that why they're so bond bullish?
I'd love to hear.
Okay, so 1982 rates were 15-20% at the long end, and they've gone down for literally. It's not just the period of ZERP. It's 1982 all the way to 2022, right? Mm-hmm. Like it's literally 40 years of bonds going only one way.
2 generations.
Yeah. Like there's not a bond manager that's alive today that is still probably managing bond money that remembers a bond bear market. And I'll tell you something funny. I wrote this piece for Bloomberg in 2022, and I remember it because 2021 had a down year in bonds. And I wrote this piece suggesting that we might get 2 down years in a row in bonds. And at the time, it had never happened. Okay. And I wrote this piece, and I got emails from very, very prestigious, very big portfolio managers telling me that I am just like everyone else that thinks that they're bigger than the bond market, and that I will learn the hard way about this. And then it ended up being that 2022 was the worst year for bonds ever. And I still remember it because I remember going, well, this is a different class of people that are telling me I'm an idiot. Like, because it was very sophisticated bond managers that were saying this. And listen, the reality is that they had spent 40 years never experiencing that. And to Zach's point, it's still happening today. They are always continually imagining we're going back to 1 or 2%. And the thing that I've been saying in terms of the bond market for the last little while is, like, even if you expect the economy to roll over, I would ask people, where do you think the Fed's going to end up cutting to? And this was before Trump. This was just a regular environment. And so we were 5 at the time. People would say 3. And I'd say, okay, so we're going to go down to 3. Well, what do 2s versus 10s usually trade at, after cutting? And they usually go up to 200 basis points. So even they cut to 3, 10s could go to 5. And I said the best you're probably going to do is just earn your coupon. Like, it's not going to be some great trade out there unless you think we're going back to that environment of 0 or 1%. And we're going to be stuck in that. And I've just continually pushed back on that because I think that I look at the decisions people are making about deficits and I don't see it. And Chase was correct. Like you told me, you said, I don't see them cutting. And I was actually more, I expected more discipline from the American kind of Tea Party side of the equation than we're seeing. And like, I'm going to ask you guys this, where are they? Like, what's happening there? There's no pushback.
It's there's a combination of the whole NIMBY, not in my backyard, right? You can cut the neighbors, you can cut the benefit the neighbor's getting, but don't cut mine. The other thing that's happened is and I think that this is just plainly evident, and I don't think enough people in the States are talking about this, but the public writ large has become so incalcitrant and so ingrained in the expectation of 10 to 15% out of the S&P 500 that anything that runs counter to that is seen as bad policy, right? And we have now officially adopted this, and folks on both sides. I sat there and looked at a tweet the other day, and I think this is telling about where we're at and the fiscal issue that we have, Kevin, is Eric Swalwell, who's very much on the left, put out a tweet the other day, calling Trump an effing idiot because of the tariff thing. And that's why we just turned your 401k into a 201k. Okay, so a couple things there. The reason I bring that up is because he's coming from very much hard left of our country. Listening to somebody on the left sit there and renounce protectionist measures because it hurts the stock market, I think that it's telling you something, culture, right? I mean, protectionist measures at the cost of the stock market is like a page out of Noam Chomsky's book, right? So like to hear, and I bring that up because folks on the right, are all about the stock market too, but that's just a huge sea change, right? That's a new thing. And so I think that we have fully adopted, that old adage is the stock market isn't the economy. I don't think Americans believe that anymore.
Oh,
well,
right.
and if that's the case, though, and if you are correct, the ultimate kind of limiting mechanism will be the bond market. They will continue spending until there's an accident in the bond market, and it won't occur in the stock market. It'll occur in the bond market first, and that's
Well, because I mean, think about it. Like, you hear people talking about balanced budgets. And one of the things I was saying is, guys, we need to do some math here. So, right, GDP contracted by 3.8% in the great financial crisis here in the US.
Yeah.
Okay. If you cut the deficit down to neutral, what kind of hit to GDP? I mean, you'd be looking at a depression.
Yeah.
Right?
Completely agree.
So where I look at this and I go, I've long thought, hey guys, we've run this ball, we've kicked this can way too far. Meaning, if you want to get this under control without crashing the economy at the same time, you probably need to try to keep spending somewhat flat and cut future spending. You're not going to be able to cut. You know what I mean? Like, you're going to lose the political will. Here's the other thing. If you're the president and the S&P's down 25%, you're not getting reelected.
Yeah.
I mean, you're just not.
Him?
Well, not for him, but I'm just saying politically, the expectations of investors in this country have just gotten nuts. It's like a birthright to get 15% a year.
Well, if you're correct about that analysis, then you sell the stock or the bond market hand over fist.
Right. What Kev, do you think, pivoting a little bit here, we came into the year and our pretty much all of our source of outperformance has come from international and gold mining equities.
Well done.
Do you think, to me, I look at this and this feels to me like we're in a scenario where not necessarily a big drop in US equities or anything like that. Anything's possible. But I'm kind of looking at U.S. equities as the piggy bank that is going to fund foreign markets, right? Meaning that I'm expecting foreign investors to sell rips and repatriate. I think you look around the world, you look at some of these markets, and it just looks like an infusion of capital, right? Which is effectively what's going on. Where do you think we're at? I from our position, I think that this is very early stages of that. But especially from a guy that doesn't live in the U.S., where do you think we're at in this? Is this the beginning of a trend shift?
Yeah. Oh, I completely agree. Listen, we've had 2 decades of money going to the U.S. Like, go look at the charts of the amount of flows that have occurred. And like go talk to international money managers and ask how overweight U.S. assets they are. Like, just getting back to bench is going to take years and years and years. It's going to just like be this VWAP that's always out there. And so I couldn't agree more. And I think one of the surprises will be that over the next decade, like, I think we could go nowhere in the US. Like, and I don't think that's that crazy. Like 1968 to 82, I think that the Dow Jones never went above 1,000, and it hit, or it went slightly above it, but it literally went sideways for 14 years. And that's what I expect. It does. Like, we don't have to have a crash. And look, this is one of my big problems with like a lot of, especially FinTwit stars. They'll come up with some theory and they'll be talking to you about this grand plan, and Moran's going to do this, or, you know, this milkshake or whatever. And they got all this stuff. And I'm like, have you guys seen the idiots that are in charge? Like, do you really like believe that they've got these grand plans? The reality is that we kind of meander from, you know, crisis to crisis, and we make these decisions. And I don't think it always has to be this dramatic wholesale change. We could just at the margin be for sale in the US. And yes, there'll be little moments when the US seems to perform well again, but then the selling will come back and it'll just be offered. And it's just kind of like almost like Europe. Like, think about Europe for the last decade. Every single time there was times that it felt like, okay, this is it. Europe's finally got its acting gear. Here it is. You can buy it. And it worked for 3 months or 6 months. And then what happened? Rolled back over and went for sale. Japan went sideways, or, you know, for another decade or something. Like, I think you're just now this last year on side from your 1989 purchase. So this idea that stocks always go up and that you're guaranteed this, you know, 8 to 10 to 15% return is just completely ludicrous. And I'm completely in your camp that we're extremely early. And I think you should be measuring this in years, not months or quarters.
One fascinating little tidbit of data. You may know this, but I was digging into this because we've been talking about it a lot on our show. But earlier this year, I'm not sure where the number is exactly, but U.S. share of global market capitalization was knocking right at 70%.
Yep.
Okay. Do you know what the Nikkei was at its peak in 89?
Was it that high? I don't think it was it?
Not even close.
Yeah, that's why I didn't think
39.
So. Yeah.
39%.
Right.
Now, obviously, U.S. is a lot bigger and big, but I mean, I up until now, I think you'd have to look back at that 89 Nikkei and go, that was the most crowded stock market we've seen in the last 50 years. Wouldn't you say?
Yeah. Some people have said that that's the greatest bubble that has been in our lifetime.
Right.
Yeah.
I think the CAPE ratio got to like 103.
I think it was actually commercial real estate was the one that they say is really insane. Like that whole thing about the land under the Emperor's Palace was worth more than the state of California.
Yeah.
It was something crazy like that.
Well, and that was kind of that. I mean, as simple as it sounds, that was kind of the baseline for our conviction to pivot international, because you're looking at that and going, I'm pretty sure we're not going to 80% of global market capitalization, right?
Although, you know, Zach, you should keep your mind open to anything stupid happening, because that's the one thing that I do think that you can be. You shouldn't have too much of a conviction in anything, because every time you say, "Oh, there's no way something that dumb can happen," it happens.
Right.
So be careful. And like I agree with you that at 80, it's just going to be a better sale. And I would never be long hoping it goes to 80. Like, that's to me what I think is the real problem, right? Is to be sitting there going, you know, 70%, but Trump's going to fix this, and we're finally going to get treated fairly, and we're going to be 80, right? Like what? like what? How do you picture this? Like, I just kind of, anyways. And listen, you mentioned gold miners. I have, if we could just pivot to that. I for the longest time, I was saying you should own gold and not own the gold miners. And it was very clear. It was basically when Russia invaded Crimea, Ukraine, and then the U.S. or the Western nations, it wasn't just the U.S., the Western nations zeroed their balance sheet or their reserves, I've been bullish gold from that day on. And I've continually said it. People have showed me the regression analysis between the US dollar or the US real rates. And I kept saying, put that crap away. Stop talking about real rates. Stop talking about the US dollar. Gold is now trading based upon the People's Bank of China buying to diversify their assets out of bonds. And I think it was Chase was mentioning that. And I completely agree. But the thing about it is that the gold market is tiny. Like compared to the bond market, it is tiny. So when you think about China, they can't go out and do it in size enough. So they're just kind of continually on the bid. So we've got this situation where every single dip is just being bought, trying to keep buying. And so for the longest time, I was like, you should own gold. Don't worry about the gold miners. I've actually switched. And the reason I switched is that for the first time during this trade, this tariff kind of brouhaha, they went and people in the West started getting bullish gold, right? All of a sudden we saw US money managers buying it. It wasn't just the Chinese buying it, right? And if you think about previous to 3 or 6 months ago, it was the most hated gold rally in the world. It would literally be hitting new highs and no one would be talking about it. And they would be telling you why it's going to go down because the US dollar is going to go up, or it's going to go down because rates are high. So for the first time, we kind of switched. We got this huge flux of money into it from Western money managers. Now, all of a sudden, it's become much more volatile. It's crazy. It's all over the place. It's trading kind of as a geopolitical / tariff thing. But the thing about it is the companies are so cheap. Yeah. Like they are just so cheap. And for the first time, we're getting earnings revisions that are headed higher. And I keep telling people that if there's one indicator you want to watch in terms of what explains a stock movement, it's just go look at the forecasted EPS, meaning what the analysts are pricing in for forward EPS. Analysts raise their forecasts, not the actual target price when they raise their earnings forecast. The rate of change of the earning forecast is what drives stock market performance. And I think for the first time, we're having a situation where they're starting to get revised higher and these guys just can't help but make money. Somebody joked and said, even at this level, the CEOs can't buy enough private jets to waste enough money to not make these things profitable. So for the first time, I love the gold miners. And then the other thing is that I think that as they start to do better and as the numbers start to go higher, you're going to get more traditional equity managers buying them. And those traditional equity managers can't buy gold. They need to buy gold stocks.
Oh, yeah.
Right? Like they're not allowed to go buy gold, right? Like you're sitting there, you have a mandate to buy gold. You have an equity mandate. You're not allowed to go buy GLD. You're buying equities. And so as they start to make money and as they start to earn positive earnings revisions, you're going to get like the pod shops chasing it. Then you're going to get those guys doing it and it's just going to fly. Like, so
momentum factor.
Like, yeah. Like, yeah, it's just, you know what it's like, Chase, in terms of like when that those earnings revisions head higher, it's, you know, and I think that they just can't help but make money at this point. It's gonna be hard not to. Oh, the other thing about it is what's their biggest output? Their output, what they're selling is gold. What's their biggest input?
Yeah.
Oil.
That gold to oil ratio has just gone parabolic.
Right. So to me, this is the time to buy the miners over the gold. I feel a little uncomfortable with that because it definitely, in a really bad environment, they're still equities and they'll go down. So that's kind of what scares me about it. Whereas gold,
you know, I hear you, and I saw the same thing happen in 08, 09, but I do think that the backdrop is such that when we do run into real issues, which I would assume most certainly would come from budgetary constraints, you know, government issues, bonds blowing up, things like that, all of those issues may push a bid into gold further. I mean, you know, and then the question remains, if you're having those issues, it's it's probably not going to be bullish for the price of oil. And if gold is still going up,
right. But the question is, if you do have the ability to buy GLD, are you better off in GLD or GDX?
Yeah, I see.
That's what I'm saying, right?
Yeah,
like that's what like I play. I can own either one. In a true geopolitical event, I want to own GLD over GDX.
That's true. Yeah, right? Yeah.
But I feel at this point there's enough of a tailwind on GDX that I feel like it makes sense to switch into the miners.
Okay, so let's do, and Chase, you can jump in here at any time too, but I want to hear your broader market thoughts because we've been having a lot of debates in here, specifically about the U.S. market. And, I think our probably biggest, most predominant view is probably pretty similar to yours. I think a period of flat, if nothing else, disappointing and underperforming results are probably on deck for U.S. markets. I can also see plenty of fodder to create new lows. I don't think that that's the most likely, but I'm open to it. What do you see going forward? Do you think we can rally and make new highs here? Do you think there's a more idiocy left in U.S. markets? I mean, it feels like it's getting exhausted. It feels like it's getting thin. But what's your read on that?
So I recently wrote a piece, and I think I titled it something like "Keeping the Big Picture in Mind," and I was reminded about this rant that Jim Cramer went on, and it was they know nothing, they don't know like what's happening out there, and he was just this rant about the problems in the plumbing of the financial system, and it was in 2007. And in my mind, that was like near the lows. Like, Chase, did you find the same thing? Like, did you think that was the lows?
I did.
I at least thought it was much closer. I mean, as you outlined in that piece, not close. Go ahead.
Yeah, but it was like I couldn't believe it. So I went and pulled this up. It was like the first dip in the S&P in 2007. Stock market was off 10% or 11%. He did his rant. It went down 13%. I think it was the spring. And then by the summer, all-time new highs, right? And like, I'm thinking to myself, okay, this was the point when Jim Cramer recognized that the world was kind of a mess. And yet we still went to new highs. And that's why I just counsel being overly confident that you can say there's no way we're going to new highs or like all I can say is I think the risk reward is very much skewed towards the short side or at the very least not the long side. And one of the other things that I highlight is I had this great chart that I stole from my buddies at Ruffer, this UK firm, and it showed the equity risk premium. And the equity risk premium is the earnings yield of the stock market versus the treasury yield. And just think back to, let's just take March of 2020 in the COVID crisis. We had a situation where the price of the stock market went way down. They were still earning a certain amount. So the yield was going up in terms of the earnings yield as the stock market price went down. So let's say it was 5% earnings yield. The 10-year treasury was 1%. So the equity risk premium was 4%, meaning you were earning 4% over treasuries to own equities. Now kind of think to today, earnings yield is 4.5 or something like that. 10 years, 4.5. It's basically zero. So the equity risk premium has gone from 4% to zero or whatever it is. This is one of the cheapest equity risk premiums we have in a while. And you think to yourself, okay, well, this is why, like, when you think about bonds going up in yield, eventually that means stocks have to go down in price, right? The trouble about this is when you look at this chart from Ruffer, you'll see that the equity risk premium plotted against 1 year forward S&P returns, meaning like if you take the equity risk premium and then go 1 year forward, what is my return? It is completely and utterly random. Like it is just, there is nothing to look at. It's just dots everywhere, meaning that there's no relationship. You might as well just ignore throw out equity risk premium because it means absolutely squat over the 1 year period. Take that same chart, take that same equity risk premium, and plot 10-year forward returns, and it's almost a perfect relationship, meaning that equity risk premium explains nothing over the 1 year period. It explains everything over a decade period. So to your thoughts, like where you have this situation where the equity risk premium's lower, I'm confident that 5 or 10 years from now, the U.S. stock market will have underperformed and won't be the greatest returns. I am less confident that over the next year that's going to be. And that's why you'll see sometimes Michael Wilson talk about this. Michael Wilson, the famed Morgan Stanley guy, he'll always say, I don't know where we're going 3 months, 6 months, a year from now, but I can tell you with confidence where we're going 5. I think he uses 7 years. I don't know their analysis. It doesn't matter. The point is that over the longer point, valuations matter a lot. So when you're talking about, your plan, I think your plan is spot on and going to be correct. I think that the challenge is making sure people understand that the certainty of which your plan is going to work over 3 months, 6 months, or a year is highly variable. The certainty which it'll work over 5 or 10 years is much greater.
I'll just add one thing, and that is, if you think about that 07, 08 like analogy, the crazy thing is, if you think about the role of passive and systematic investing now versus 08, like you even have that much more like potential power to like rip to that new high than you even had in 08.
Yeah.
Which makes that, speaking of just whatever that was 2 weeks ago, whenever I filled in on the huddle, I was telling Patrick, like, I think we could hit 6,000, this summer, like no problem. And he looked at me like I had two heads. And then now I look and it's like, we might get there before we get to summer.
You might still be on. I'm still doing my jury duty, buddy. You might still be coming back.
That's fine. Vincent did a really good job this past week as well. Speaking of, something Vincent mentioned that plays into a lot of this that I find interesting is, like, obviously we were talking about, like, the U.S. got to 70% of equity allocation as far as countries go. But then at the same time, if you just break out equity holders by basically any category you want, U.S. households, obviously just the retail crowd that within that is significant. If you think about pensions and insurers, but then you think about all those people globally, like basically you can't really find a bucket of investors that hasn't taken that equity to kind of a new high. Proportionally. This is where the bond bear market gets sort of interesting, especially for real money, for pensions, insurers, endowments, sovereign wealth funds. Like if you let's say we do get to the 6, 7, 8% or something on the long end, and let's say that's pervasive globally, like you're hitting these new highs, multi-decade highs in Asia and in Europe. At some point in there, the real money is like, okay, well, if you're going to give me that for fixed income, I'm taking it. You can have your equities back, and you might get that de-risking where the bond bear market's so bad that it's good for real money, and they plow a lot into equities in sort of a grand, reallocation. Any thoughts on the potential for that?
I think you're spot on. And I think that if you listen to guys like Howard Marks, who knows a thing or two about investing, he's already making this argument. He's talking about the fact that if you go and buy corporate bonds, you can get 8%, and wasn't 8% what we were all shooting for? And the real problem right now, I think, is that people have been conditioned, as per Zach's point, to expect a lot more from that. So once we finally do get a true decline, I suspect that trend will accelerate, right? It won't be until you get stocks no longer giving us 10 to 15 that you're going to get that thing. And then it'll just keep going. And that's ultimately why I do think you'll get just a decade of going sideways, that once it finally comes off, you're right. There's going to be a lot of people that just go, hey, wait, why am I in this stock market? And not only that, think about it from a demographic point of view as well. The boomers
100%.
are retiring. They're leaning less risk. And ironically, like, I don't know, you guys could probably speak to this a lot better than me, but my conversations with wealth advisors, they are continually shocked at the amount of risk that more advanced in age folks are taking with their portfolios. Do you find that?
Oh, 100%. I mean, I see 4 and 5 stock portfolios for people retired with, portfolios between 1 to 2 million all the time.
Yeah, and they're all in Mag 7. They're all
100%. Yeah.
We had a guy in his 80s that was wanting to chase something crazy, because that one was floored me. Someone told us, like, oh, this guy's like 80 something, and he wants us to go like buy him a bunch of Palantir or something. You're just like, what?
Yeah. No, there is, like I said, it's the risk perceptors are just muted. They're just off, and nobody believes that you can lose. And I mean, that's why you see them bidding up Costco at 60 times earnings.
Oh, it's funny you mentioned that one, because I have a buddy, this smart hedge fund guy, and he's always talking about, he goes, everyone talks about Mag 7 and how expensive it is. And actually, I could kind of understand why you bid for Mag 7, because on a peg basis, it's not that bad.
Yep.
But he says, like, go look at Costco. And he goes, great business, but the idea that you're paying 60, times earnings for such a boring business is nuts.
For Kevin, for 8%, 7.5% revenue growth and 2.7% margins, you're paying 60 times earnings. No one's doing the math. Yeah. Like, you can't get paid back.
Yeah. So I have a theory about that. And Chase, I think you're going to like this one. I think that is a function of the bastardization of markets via factors and quant investing. And I think ultimately what's happening is that even people that aren't specific quants, even just regular portfolio managers, they tell me that they get a list of stocks they're allowed to buy. And so, like, there's a bank portfolio manager that I know, and he says, yeah, I basically get this list of stocks that I'm allowed to buy. And basically what they're doing is they're screening for certain factors and then allowing him to choose his names from those factors. And the reason Costco does so well is because on the quality basis, like the stability of earnings, the raising of earnings, it screens so well. And the problem is nobody's got a valuation filter on any of these factors. And so it just kind of builds upon itself, and not only that, it's self-reinforcing. So you get this situation where it's going up because the earnings are so stable and it's screening well on a quality basis. But because it's going up and doing so well, it causes more people to buy it, and just nobody ever sells it. It's shocking. There's nobody sitting there and saying, okay, even though this screens well, it's 60 times earnings, I got to take it off. It's the factor's gone awry. And so I thought it was really interesting that Cliff Asness, the AQR guy, was sitting there talking about how the market has become less efficient, and arguing it has. And I tend to agree with him. I do think the market's become less efficient, but I think it's because of him.
Yeah. Yeah. Well, and then the whole passive thing, just like, being extra fuel to that fire, right?
Yeah. But I think that the factors and the quants are an underlooked, and too many times we blame the passive. And I think that the factors and the quants mean more than people expect.
You're right, because quality's been on so good for so long. Everyone's in it. And if you talk about the earnings revisions, I'm sure they haven't disappointed there. So I'm sure the people that chase that have done it.
The part that really surprised me, that really opened my mind to it, was the fact that traditional portfolio managers were getting constrained by those same lists.
Right.
That was the part that really opened my mind to, like, because I was sitting there like, oh, well, why do they own it? Like, what? And it was because they're forced to deal with just this list of stocks that they can buy based upon those factors.
You think about our buddy Warren Pies with FCTE. I mean, it starts with quality,
Yeah,
and then goes to trend. He
have any valuation filters.
No one does. That is the point. Is it's quality. It's fine. Like I think people think like quality equals relative safe. So who cares about valuation? Because for most of history, it didn't like quality wasn't the most expensive. So
and to be fair, the U.S. more money comes into it, and it's this forever lifting, all boats. And it really won't be till money starts flowing out that all of a sudden all these things stop working.
Which speaking of, I one of the most interesting things from that it to me is when it flows out, like the channels, the pipes into some of the places it goes to are so small. Do you think there are some just really outsized opportunities for, some countries, some places that their pipe is so small that if it becomes a good story, like the flows are just so overwhelming. Like you talked about like the gold market earlier. An example I've beaten to death here because it's one of my favorite places to invest is Greece. Trades under 10 times earnings, right around there now. But if you try to buy the Greece ETF, like you better not have much money to or you'll move it around. And that's right. just one example.
I saw someone the other day talking about Brazil. And they were saying, "Oh, Brazil's a great market. I'd love to buy it. It's not big enough." And I was like
so one of the biggest countries on earth.
Yeah, but for like the real big players, it's hard, right? Like, I think it was actually that Michael Semblast guy from JP Morgan that was saying that. And I completely.
And that's one of the more liquid country ETFs that you can get too.
I think we're gonna see my thing about the series of rolling bubbles. That we're going to see like little mini bubbles. We'll see them all of a sudden. Your Greece will go from 10 to 20, and it'll happen in 6 months, and you'll be like, "Holy smokes, this used to be cheap," and it'll occur, and then they'll go from Greece to Brazil, or they'll go from Brazil to Canada, or whatever. And you're absolutely correct. Like I did the math on that gold miners piece that I wrote, and it was like the dollar value of a daily change in NVIDIA was like a huge portion of the GDX total market cap. Like it was just like, I was like, oh my God, like it's going up and down the entire GDX market cap every single day, just one stock. And those seven stocks are so huge. And listen, here's another thing we haven't talked about. And I it's kind of gone off the front page, but the reality is the concentration in the US is out of this world, and it's obviously been fixed a little bit in the last couple months. But if you go back in time and look at other periods when we were this concentrated, it was like 1929, it was 1972 in the Nifty 50, it was 2000. It was like all these periods where the forward returns were terrible. And I think it's just another one of those things that you put and say, okay, I don't know when this is going to happen. I just know that when I'm buying a stock market, and what is it, 35% of the stock market cap is these 7 stocks, and who are all, by the way, in the same industries almost. Like that's the other thing. It's not like have 7 different industries. It's the
right. If we don't
industry.
need cloud computing anymore, like half of them are going to have a problem.
I think that there's another one of those situations where, like, thinking about it 5-10 years from now, it's going to be like the equity risk premium. You're going to be like, it was so obvious that at that level of concentration, it was a dumb bet to take.
Yeah, well, you've got to, I mean, I was just doing the math real quick. So we're at 4.5% on the 10-year. Costco's shareholder yield is south of 2%.
So it's a negative equity risk premium.
It is. And look at the growth. I mean, they're forecasting 5.6% growth this next year, margins of 2.7%. It's wild, right? It's wild to see stocks like that where you go, no, the market doesn't know something. You guys are just nuts, right? Like that stock is not even, we're close to that valuation.
Well, listen,
but they're not nuts because they're not even looking at the valuation.
The market gets stuff wrong all the time. This is one of my big pet peeves when people say the market knows better. I'm like, yeah, okay, the market knows better. If you're fighting with it, and you got to be careful about your timing, but the markets get stuff wrong all the friggin' time, like all the time.
We wouldn't be here if it didn't.
Yeah. Like, Like, I just think back to, like, January of 2024 or 2025, like that, when I was sitting there in New York City and I was like telling people I think the stock market might go down. If I just listened to everyone and said that, then I would have, you would have missed the 20% decline. Market gets it wrong all the time, and it's very influenced by people. Like, I've been actually kind of shocked at how the sausage is made in terms of how these narratives take off, and I can see them actually occur. Like, I'll have buddies that'll be like, they'll give me an idea or give an idea that they'll share, and the next thing I know, I see it kind of gaining traction, and then I'll see it moving markets, and I'll be like, Jesus, like, this is just like, like, I like the guy, but he's like, he doesn't know any more than anyone else. But you'll see it kind of spiral, and it's just kind of fascinating. Like, markets are wild in that they're way more influenced on the day-to-day and even over the longer term than people think by narratives. Like, think about, like, Einhorn wrote that whole book about him trying to, convince people that stock was a fraud. There was 100% fraud. It was like fooling some of the people all the time, or whatever, or fooling most of the people some of the time. I can't remember what the name of it was, but it was like very clear that it was a fraud, and nobody cared, and it just kept going. And I feel like, to Zach's point, a lot of times that's where we are right now in the U.S. stock market as a whole. Everyone's making money, and it's just piling back, in and in and in. And what's happening is the smart guys are quietly selling. Like, it's no surprise to me that Warren Buffett's sitting on the highest cash level that he's ever done. Like, the really smart guys aren't going to go and say, I think you should short it. I think you should be out of the stock market. They just kind of quietly leave the party. And then the cops come in later, and then they're like, "Where's Warren?" Well, Warren went home 2 hours ago.
Yeah. No, I agree with you. And then the other part of it is, and you don't get the full picture. And I've said this a bunch of times. You don't get the full picture looking at the indexes themselves. Speaking to international indexes, you start digging underneath the hood, and it is just shocking, the value out there.
Oh yeah.
The quality companies that have just been left for dead. And then, you're comparing them to what would be like a US counterpart, and they got a better balance sheet. They got better growth metrics. They got better margins, and they're trading at 1/5 the valuation. It's just, it's mind numbing.
Yeah.
It's beautiful. Is what it is.
It is beautiful for the long run. Right. But, we had not a ton, but we had clients fire us last year because we were up 15.5 and not 23, and, so you're in this environment where you're like, look, I know what the right decision is to do long-term. Right. The question is my client base going to be able to hang in and deal with the idiocy they see on the sidelines, while we go there, and that's the rub, right?
Yeah, that's what makes managing money so difficult. That's what I always tell people on a retail basis, why they're at a huge advantage. They don't feel that pressure,
right?
Like, they feel it personally, but they don't have the need to outperform. Like, there's nothing wrong with a retail retail investor saying, listen, the market's really expensive. I'm going to walk away. I'm going to be like Warren Buffett. I don't care if my neighbor's up 40% in the next year. I'm like, right. And you unfortunately don't have that same luxury. And people don't understand the pressure that you as a money manager have of, competing against that index. It's huge. It's really, really large. And that's like
it is, but I don't know if you've been there before, or if you feel similarly, but Chase and I have talked about this a lot. The spread has gotten so wide, and I think the value opportunities are so attractive internationally. And I was telling this to our clients, I go, I don't know what it's going to look like over the next year. What I do know, as a fiduciary of other people's money, where I need to put it, right? That decision's made for me.
Yep. No, you're absolutely correct. Now
hey, sir, we have one question left for you.
Okay.
And then we'll let you get out of here. Where do you think we're at with the dollar? Do you think this uptrend has been broken? And do you think that we're heading south, and not necessarily, not even saying in a really dramatic way, but has this long dollar bull finally given, and do you think the trend has shifted?
Yes, I think that you can't have my argument about fiscal increasing throughout the rest of the world. You can't have my argument about money flowing back to these places without also being a US dollar bear.
Yeah.
And it would be intellectually not, correct for me to sit here and say, no, I think dollar is going to go up. And the reality is that I think it's just started. I think that you guys have the most expensive currency in the world. Like, as I said, my buddies go all over the world and they say how cheap everything is. And I go, no, the rest of the world isn't cheap. You're expensive. And it makes no sense. It's a kind of, and listen, I don't even think it was good for you guys. Like, I really don't. And I think that the U.S., like Trump is trying to fix a lot of things with tariffs. Personally, I would work more on the dollar. Like, I would tell like China, no, you're going to revalue your currency and it's going to be higher. And I think that's ultimately the problem is that we, had the dollar not being manipulated, or had the renminbi not being manipulated by the People's Bank of China, it should have been higher. It should have had, as you guys were buying goods, it should have caused the renminbi to go higher. But they stood in there and they created renminbi and then reinvested the money in the U.S. And that's what caused all these distortions. So it's in no one's interest for the U.S. dollar to stay up here if you're trying to rebalance the economy. And to me, it seems like he's pretty serious about trying to rebalance the economy. And I think it ultimately has to be a much weaker U.S. dollar.
Well, the irony that you point out too is a DXY at 85 makes it a heck of a lot easier to rebalance the economy.
Yeah, but ultimately, so it's really tough because in some extent, you guys have actually become richer through the dollar going up, right? And I would argue that you become richer, but that you become more unequal.
Yeah.
And that is really, truly your problem, right? That you've lost manufacturing jobs, and you've had this situation where the money has been increasingly gone to the tech area. And not only that, because it's tech, it's in less hands. And like, you guys don't have a wealth problem. You guys have a distribution problem. And that's the really kind of scary part about it, because realistically, let's just imagine that you were able to tax Elon and Bill Gates and all these guys at a better rate. You'd fix a lot of your budget deficit problems. Like, you could fix a lot of things. And I know, like, that's completely, then people say, oh, no one's going to work and stuff like that. And like, I hear this all the time. I remember like let's just take a obscene example. Schwartzman from Blackstone. He once said, if you take away my carry interest, I'm not going to work. Like, okay. So he's got the lowest tax rate. He's basically carved himself out this unbelievably sweet deal. And he's threatening the country that has given him this great advantage, that's allowed him to become one of the richest people in America. He's threatening them with not working because they want to put it to a fair tax rate. Right? It makes no sense. Like, it's just and listen, I know that's not a popular view, because everyone's going to go, well, if you start taking away from people, then no one's going to want to work. I get it, but I don't know how to fix it. But I do feel like you don't have a wealth problem. You have a distribution problem.
Well, and the carried interest thing is different. I mean, that is an exclusion and a carve out designed by hedge fund guys, and they protect it by donating to politicians' campaigns.
But there's a million of those, Zach.
I know, and I'm with you. I think it's garbage. Like, for instance, how is it we both get paid off of returns off of client accounts, but mine goes as personal income and yours goes as a cap gain? How does that work? Like, it's a nonsense. It's nonsensical, and it's total self-serving, and it's allowing the rich elite to buy policy in Washington that doesn't make sense to anybody. Buffett's talked about it for years. You know, my assistant's paying a higher tax rate than I am.
Yeah. And ultimately that's the real problem. And like, that's why I always go back to my thing. You know, Trump says the rest of the world is taking advantage of us. And I'm like, well, you guys seem to be doing pretty great in terms of the amount of wealth that you're taking out of the rest of the world. And like, I don't know if that's really your problem. Is your problem that the rest of the world's taking advantage of you, or is the problem that you're having trouble distributing it, the money that the wealth you're creating?
Yeah. And you've become over financialized too, which, you know, that doesn't benefit the working class. Yeah, right.
Exactly.
So,
like, going back to your point about everyone earning 10, 15%, and they have been, like, that's just making everything more unequal.
Yep.
Right. Like, I have buddies that tell me that, like, their dads, like, he says, my dad's, you know, his house is paid off, and he took out a HELOC and he puts it in SPOOs because everyone in the golf club does it. Seriously.
Been a great trade.
What could go wrong?
Yeah.
What could go wrong?
And we laugh, and I say, well, you know, he goes, if I asked him how much of that SPOOs is in 7 stocks, he'd shit a brick. Like, he has no clue. No clue at all. Here's one last story I'll tell you that was interesting. I have a retail broker friend that told me that at his bank, if he tried to create the portfolio for the NDX 100, like, if he tried to create that portfolio for a client, he wouldn't be allowed to for concentration and risk problems.
Yeah. Compliance would never approve it.
Yeah. Isn't that
but
wild?
you can go, but you can throw the triple Q in their account.
Yeah.
Right.
You could probably do the leverage ones if you wanted to.
Yeah. Because it's diversified.
Exactly.
Oh man, that's too good. Well, hey pal, great catching up with you. I really appreciate you taking the time, man. And where can the folks find you? So we've got give us the rundown.
Go to MacroTourist.com. Go check out my chat on Substack. I think there's a link there. And send me an email if you want me to send you some pieces. Kevin@themacrotourist.com. Listen, thank you very much for having me on. It was great chatting with you, catching up. It's been a long time, and it's great to see Chase. He is my fill-in, but I don't get to talk to him very much because we always have him on when I'm not there. So it's great to chat with him.
Great to chat with you. And I just want to tell everyone, I could not endorse MacroTourist enough.
Same.
Like, so much of what we talked about today, Kev has like a great piece that goes into awesome detail explaining all this stuff. So
thank you. You're very kind.
It's had a huge impact on me and my work.
Yeah.
So Bulwark's work.
And in plain language too. That's one of the things I appreciate about you the most, Kev, is you're what we talk about. You're a workhorse, not a show horse. No, you know what I mean? Like, there's so much
says about me too.
Well, but you know, so many of these guys, you read it and you're like, there's so much esoteric nonsense in their take that you're just like, okay, so buy stocks, right? That's what you're saying. And I just love the way you make it. You put everything in plain English, and you make it very easy to understand and to digest. So I think it's I think it's great for retail people that are trying to get a better understanding of the way things work, because you delve into the big macro stuff, but you do it in a way that people can understand it.
That's
So
very kind of you. Thank you very
appreciate
much.
it, pal.
I had a great hour and a half with you guys. Thank you very much for your time, and thanks for having me on.
You bet. All right, you guys, that does it for us. And we will be checking in with Kevin probably later in the year, see how things are playing out. But that does it for us today. We got to run. We got another great interview coming up, I believe, later this week or early next week. So you want to stay in tuned. As always, you can subscribe at knowyourriskradio.com and Google us on YouTube or search us on YouTube at Know Your Risk Podcast. That does it for us today. Have a wonderful evening. We'll see you later. This is the Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.